In quantitative trading, the single most expensive error an operator can make is mistaking a complete structural failure for a healthy market pause. A system built on raw candlestick wicks introduces an unacceptable margin of error. Price action provides the history of a move, but it obscures the internal mechanical pressures that determine if that move will actually hold. This creates what we call the blind cockpit problem. This diagram shows a raw price line dropping sharply before pausing. At this exact millisecond, looking only at price, differentiating a temporary dip from a total collapse is mathematically impossible. Legacy indicators fail here, fracturing price, momentum, and volume into completely isolated, disconnected data streams. The V4.4 pullback profiler solves this ambiguity by abandoning isolated indicators entirely. We cross-reference price location directly with a momentum engine and an exponential volume filter. To understand exactly how this architecture protects your capital during a pullback, we are going to reconstruct the system layer by layer, directly from first principles. Mastering quantitative execution requires transforming fragmented guesswork into a single interconnected mathematical logic gate. The first layer of the new architecture establishes rigid physical boundaries on the price chart. We begin with the 34-period exponential moving average, a sharp, glowing band tracking downward price. Directly beneath, the 50-period average plots the lower boundary, creating a parallel channel. This highlighted area between them forms the primary chassis floor. Historically, this specific geometric zone is where institutional algorithms typically step in to absorb retail panic selling. When price drops rapidly, massive institutional limit orders are clustered precisely within this mathematical bracket to catch the falling asset without crushing the broader market structure. However, location alone guarantees nothing. Just because price physically enters the chassis floor does not force a reversal. If internal momentum is completely dead, price will simply slice straight through the floor. Geometric location is a strict prerequisite, but it remains effectively useless without a secondary engine to mathematically verify the exact moment institutional momentum activates. To mathematically validate the price action occurring inside the chassis floor, we need a dedicated momentum subchart. Legacy indicators keep this momentum data completely decoupled from actual physical price location. The top chart doesn't speak to the bottom chart. V4.4 fixes this disconnect. A vertical logic gate hard codes price location directly into the momentum engine. The microsecond price drops into the shaded top zone, a data pulse shoots down, instantly illuminating the corresponding histogram bars into a neon gold active state. This visual shift represents real-time mathematical validation. It confirms that institutional absorption activity is actively firing at the correct geometric location. By interlocking these two layers, the system removes human emotional guesswork. It provides a strict, binary yes or no signal straight from the machine. Yet one missing variable remains. Even when location and momentum are perfectly aligned, a lag in volume data can still trigger a catastrophic false positive. Linking price and momentum creates a powerful early warning system, but unless we filter out volumetric friction, the entire setup remains vulnerable to the noise of past data. We call this noise volumetric friction. Identifying a true drop in volume, actual market exhaustion, is a mandatory requirement for a safe pullback entry. The legacy method for tracking volume relies on a simple moving average to establish a baseline. The simple moving average assigns equal weight to all data points. On this 3D chart, a massive historical volume spike sits 15 bars in the past. Because the average weighs that old spike equally, the lagging baseline sits artificially high above recent quiet bars. V4.4 deletes the simple average, establishing an exponential moving average baseline. This formula shifts mathematical weighting to immediate data. The old lagging line dissolves, and a new hyperreactive line snaps down abruptly, tightly hugging the recent quiet bars and ignoring the past spike. Removing this historical lag finally reveals the true immediate state of market participation. This specific shift to an exponential baseline allows the algorithm to detect true institutional exhaustion with surgical precision. Replacing simple averages with exponential formulas is the only mathematical way to isolate immediate micro-exhaustion without being blinded by past volatility. This brings us to the convergence protocol, where location, momentum, and filtered volume align. The precise volumetric trigger required for this final validation occurs when the new exponential volume line registers exactly 25% below the established average. In this synthesized UI, price rests securely in the 3450 shaded zone on the top chart, while the momentum histogram actively illuminates. As the volume line drops past the threshold, a glowing validation node drops directly onto the momentum histogram. When these three layers align, they signal a fundamental shift in market participation. This mathematical convergence indicates that retail selling pressure has been fully absorbed by institutional limit orders. Effective pullback profiling requires completely eliminating historical lag and hard-linking previously isolated datasets into a single cohesive engine. Contrast this mathematically rigid approach against the amateur method of guessing where wicks stop. Your systemic edge is found entirely in the transition from lagging simple averages to hyper-reactive exponential matrices. Algorithmic insight relies on precise measurement of the present state of an idling institutional engine. Success comes from identifying the exact moment those gears engage.